15 November, Tuesday, MAO with Cal, once again. Now, US unemployment will hit 5% by March 2023. Do you think so? Well, this is my personal take. No article to stand on it. But based on what I'm seeing right now with all the layoff going on, and I've been expecting this to happen, it seems that this is actually going to happen. Okay, so I'll tell you more in details, and we'll look at what Morgan Stanley Mike Wilson has for us, his outlook, and apparently it's a bit scary because it's a bit same with mine. So that's why I want to share with you. Okay, let's go. Now, once again, guys, disclaimer apply as usual. Please make sure that you do your risk assessment, and thank you, Ames, for the kind sponsorship. Now, first of all, let's cover this story first. The world is big enough for two tigers. Well, apparently Biden and Xi Jinping has met, okay? And Biden sees no need for a new Cold War between USA and China. Well, apparently Biden is still pretty objective towards to China aggressive approach to Taiwan in a 3 hours meeting with Xi Jinping. All right. So we can see on China News Asia, both of them have agreed that nuclear weapons should never be used. That's good. Okay, that's a good news. Okay, hopefully it stays there. All right. But of course, the main thing that everybody's focusing on is whether this Biden can convince Xi Jinping not to, take over or take back this Taiwan. So apparently, Xi Jinping told Biden that Taiwan is the first red line that must not be crossed in the China-US relations. So very clear, right? I mean, Biden want this to be like there's no more China to come back to take back Taiwan, but China is pretty clear that China's really clear that what they want with Taiwan. So this is something that I don't think is going to help. And of course, when you have two tigers in a mountain, right? Sometimes in the Chinese saying, it's not very possible. So let's see whether will this really turn out well. Okay. Now, before that, let's look at the US market. Okay, now the US market today is pretty interesting. Now, the start of the morning, okay, we can see that it gaps down first in the morning, okay, the US morning, and then it recovers pretty strongly. Now, what's the reason for this recovery? Because we know that the Democrats has won the Senate, okay, and there is a very close fight now for the House. And who knows? The Democrat may just niche it by in the last minute. Who knows? Okay. Then after that, we also know that this Brainer came in and said that there is a good chance that the pace of interest rate hiking can reduce, and that propelled the market higher. But do you notice something very interesting? Despite the market was going up, right, the volume involved is quite stable. This is S&P 500 volume, okay? Then at about 2 a.m., the magical number, which is always the case, right? At 2 a.m., something just gave in, all right? The volume start to surge and the market start to sell at a very alarming speed, okay? So which means that the entire gain from this point here itself is all taken out within a span of, let's say, 2 hours, okay? Apparently, there's some statistics going on. There is that, right, in total, there was about nearly $3 billion worth of the equity stocks traded, and almost like 70% was taken out in the last 2 hours. So this is something to watch out for, traders. I'll share more in detail to you. And of course, the headlines is that the S&P 500 and the NASDAQ actually snapped the 2-day rally. And I'll be sharing with you guys, most likely it will happen because once the confirmation of the Senate is there, I mean, it's very confirmed, right? So most likely after the midterm election, there will be some profit taking. And of course, we all know that the last 2 weeks of rally is very clear that it was kind of like artificially pushed up because it doesn't make a lot of sense of the market to be going up right now while the earnings is coming down, right? So okay, hold on, some technical side. So we can see that, right, the vice chairwoman, okay, Leah Brenner, indicated that the bank could slow down the pace of the interest rate hike. But of course, Christopher Waller, another Fed governor, says that, right, there's still a way out here, okay? So which means that there is a lot of dove versus the hawks in the moment. Now, tonight will be the PPI data, and the number is expecting to be 0.4%. Now, previously was also 0.4. Okay, so what we can see over here is that since August period to September period to now October, it seems that the number from PPI is going out. Now, what's PPI, by the way? It measures the change in the price of goods, okay? Means like a bit of inflation sold by the manufacturers, okay? It's a leading indicator of consumer price price inflation, which is CPI, which actually accounts for the majority of the overall inflation. So by right, if the number is going up, right, definitely that means CPI data should be going higher. And of course, naturally, if that's the case, it will push the dollar higher, hence, because that means that interest rate has to move up. All right. So unless they also motivate this number, because the last CPI I already expressed my concern, I don't think that is 7.7, but of course they really do something with the healthcare side, so the number not say altered, more like it basically maneuver the number a bit. So if today they already got what they want and they let the market really have what they're supposed to see, and if the number is like 0.5 example, wow, the market will wake up a little bit, and I believe there will be further profit taking. Okay. Now to Wednesday, we call retail sales, nothing much on that, but on Thursday we have the initial jobless claim, and of course in this number I expect it to go higher. Okay, I expect it to go higher. I'll explain more in detail shortly. So what's the main reason? Now, since the start of June, I've been telling people this: if the Federal Reserve is going to continue to hike rates, right, the next thing must happen will be the layoff. Now, Jerome Powell has already said that there'll be more coming into the industry, to the people, and now it's happening. Amazon has reportedly plans to lay off about 10,000 employees starting this week. Oh gosh, okay. So this is actually the largest in the company history, okay. Now think about this. We are going to have our Thanksgiving, our Christmas season, and for them to do this right now ahead of the season, right, that's tell you that they are really desperate in certain manner. Okay, that means the numbers are really not coming up itself, the economy is not doing that well, and there's a bit of worry. So that is whereby I'm sharing with you guys things is not going good. And of course, we can see that not only Amazon, we know that Meta have decided to lay off about 13% of their staff, which is about 11,000. Well, that's another big number. And of course, we have Twitter letting off about 3,700 by Elon Musk, and Microsoft let go about 1,000 jobs. Now, there's more other tech companies that actually release people, but there's too many to cover. But just this alone, collectively, I have calculated easily about 30,000 jobs. Okay, that is all the top firms. So you cannot deny that. How about those in the middle or the smaller company? What will they do, right? Most likely they will also cut. But what's the next one that I'm pretty worried is the retail industry. That means that like Walmart, okay, and we have Fob, right? They will also be cutting, right? This is all from the insider. There are news going on that they'll be cutting, and Walmart numbers are coming out this week. So I believe that the retail industry will also be taken up. So that means that there's a very good chance to see the unemployment data going to 5%, and that's exactly what the Federal Reserve wants. Okay, just take note of that. They want it because when you have lesser people involved in job, inflation theoretically by statistic can go down, right? So let's take a look at this one here. This is a very powerful chart I want to share with you right now. Okay, this is the Fed economic data. Okay, from St. Louis Fed. Okay, I want you to take a look here. Now, from 1948 to now 2022, that is a cool 70-year history. Okay, so what I did was I put the 5% mark in myself. Okay, this is done by myself. Okay, do you not notice that? Okay, that when that time when the market hits the 5% mark, right, you notice that usually it comes with this thing called recession. Okay, so you can see that every time when they hit the 5% marker, right, you can see that it will be at the epicenter of the recession. Okay, this one is already way past 7.5. I can skip that. Here's 5%, here's 5%, here's 5%. Can you see that? Okay, so you can see that every time when we hit the 5% mark, we will have the recession. So if let's say what we are seeing is evidently clear that the number is going to go upwards towards the 5% mark, then that means that recession is going to happen. So that's the reason why a lot of people have been saying that, may not have recession. I say it's impossible. I'm going to put my pen here. Now it's at 3.7. I'm very confident we'll see the 5 mark before March or by March 2023. And of course, when that happens, naturally you do have to see two things to happen. The equity market will pull back down, that's for sure. And of course, the Federal Reserve will likely pivot later. Okay, so that's the reason why I tell my friends around me and say, look, if you want to buy stocks right now, don't buy too many now. In fact, there will be a chance to buy it cheaper later on. And then when the unemployment data hit 5% and the equity market goes down to S&P 500 like 3,002, 3,000 level, bang, that is the time to buy, because that time itself, recession will be on the table and the Federal Reserve will likely do the pivoting. This is my personal take right here. So now let's look at what Morgan Stanley, Mike Wilson says. Okay, this is actually exclusive from him, and let's take a look. All right, now this guy has nailed for 2022, almost perfect. He called for sell back in January, the market collapsed. After that, he called for sell again, the market goes down further. And then recently, he gave the buy call, the market bottomed out brilliantly. All right, so this guy really is pretty hot right now. How does it look like? This is guy, this called Mike Wilson, right? I've been sharing this guy over the last whole 6-7 months. Okay, so Mike Wilson has said the stock market is likely to make a new low early into 2023. Oh gosh, before building momentum into the second half of the year, okay, and it's pretty in line with what I just said. In fact itself, right, he's saying that it should reach 3,000 to 3,300 by the first quarter of 2023 as the investors grapple with the low, slowing economy before rebounding later in the year. So it's the same thing again I mentioned. Now, he is actually looking at the 2023 to hit about 3,009. Okay, now it's about where we are right now. So it seems that he really expects the market to really dive down to 3,000 to 3,003 first, and then after that, pick up from the bottom and recover all the way. And I totally agree with this, with what I just said to you regarding about coming off first, then after that, the Fed thing and the market just go all the way up. That is exactly what I have shared with you moments ago. So of course, I've been saying the same thing for quite a while, but it's good to see that Mike Wilson also shared the same thing. In fact, I say again, Mike Wilson now has been one of the most accurate strategists in Wall Street for 2022 because he really has predicted all the incredible sell-off and all the short-lived rebound, and he even predicted the technical rally 2 weeks ago. So he is really, really good. Okay, get some detail online on him. All right. So let me share with you now why the likelihood that there will be more selling to come and why companies most likely are releasing people. Because since 2021, right, this is from Bloomberg, okay? Now, the one in orange stands for the company beating the S&P earnings. The one in red is the missed, and of course in gray is met. So you can see very clearly now that if I draw this for you, you can see that the numbers are coming off. This evidently tells you that the the companies are basically not able to beat the estimate. That means that the upside potential has really reduced. Most of them are missing now. You can see that most of them are missing now. That's the third quarter. And those who met this out, right, probably it's just revised. So what is going to happen in the fourth quarter for 2022? I suspect that this number will go down even lower. Yes, go even lower. So that's the reason why the companies now are laying off people, because they know that if they don't lay off people, right, the earnings are not able to match, and it will have even more drastic problem. So for big companies, they need to do a lot of balancing act, because their money they borrow from the bank itself, that interest coming in, higher interest now with the interest rate environment, and of course when the banks basically base their loans according to their earnings, if the earnings are to be suffering because due to the high cost, then naturally it's right, things will get very bad. So that is the reason why I realized that recently. Now this one, take note, this is the record institutional. Now do take note, this is not the retail level, this is the institutional. So the institutional now apparently has basically been buying a lot of put while the stock market was going up. So this is again a very important information. Now the previous time when I shared this was the retail, and of course when the retail was buying, the stock market came off first, right? Then after that the market just reversed and all the retail get fried. This is by institutional. So that is the reason why I am going to tell you this: be very careful. Okay, something is just not right at the moment, just go slow, put some trailing stop, and watch out for the next potential turnaround. So of course this is a chart that's been going viral for the longest of time. This is basically putting the 2008 to 2009 chart versus the 2022 chart right now. And amazingly, we have a pretty exciting accuracy among it. All right, pretty accurate. So where we are right now is somewhere like here, and hence therefore it seems that, right, we are going to see a dipping November to December, which is something that contrary to what people are saying right now. And of course, if you actually buy into what this Mike Wilson say, and of course plus what I said regarding about the potential bad earnings coming in, and the first quarter will be pretty bad, that means that the market will likely be behaving like what happened in 2009. Oh gosh, if this is going to happen, it is quite scary, because if you look back again, right, that means that currently right now we are at 3,900. For it to do the same thing as well, the S&P 500 must go down to 2,000. Now I don't think that we will go down to 2,000. I think that to see 3,000 is good enough. Okay, if the market can really come down and go down to 3,000, it will be good enough. Okay, even though this chart is very scary in terms of the correlationship and even in terms of the tagging towards it itself, it's quite scary though. All right, now rather than we look at something that is like superimposing on something else, let's look at something much more what they call reliable in my opinion, and that is Fibonacci. So let's take a look here. Now this is the A and this is B, just to give you a highlighting point. Now this is what happened during the June period where the market bottomed out and extended its gain all the way to August period. So take about 2 months, right? Okay, so what I did was I take the lowest point to the highest point to do the Fibonacci, and you notice that once the market hit the peak itself, the first time when it goes down, it will go down to this particular point, and that's the 23.6. okay, and you can see that it firms around there for a while, recovered a bit over here, and then bang, when it goes down, right, look at the way it comes down. Oh my god, the accuracy is super incredible. It's as if that someone has already pre-hand drawn this thing up front. And when the market dipped down all the way, this is very important right now, it went to the 61.8. Now we all know that the Fibonacci 61.8 is a very critical level, and apparently the way the Wall Street use it is fantastic. Look at it. It stopped there and then rebound all the way. And that time itself, I remember a lot of people was caught on this. They jumped into buy, and I was telling people, be very careful. This could be a bear trap. And wow, look at it. It slammed. And when it came down itself, once it loses 61.8, the market just go down all the way. Okay, so now we focus on the 23.6 and the 61.8. Okay, so let's just not look back here. Now this is the so-called A1, okay, the lowest point recently, and coin as B1, okay. So what you can see right now, we have about the same thing right now. If let's say this is the highest point, the first 23.6 will be 3888. Wow, nice number, 3888. If the market can stay there, okay, then the market will likely rebound, all right? It may rebound, okay. But if the market fail and start to go down instead, I believe that it will go down to the 61.8, and that will give us 3,700, okay? So we are using what happened in the past and see whether what will happen now. Now, something that I want to tell you this, guys, there's something that you need to take note. Difference is this. When the market was surging up back then, the volume was actually kind of going downwards. This time around, the market volume is kind of pretty consistent, although the last 3 days was coming off. So I will just want to tell you this, okay? Maybe the pull down may not be as scary this time around, but because the lowering volume the last 2 days, I'm kind of worried. So I believe that a pullback down to 23.6 or 3,888 is high. But if the market really break 3,007, then I'm very confident tell you that we will see 3,002 to 3,000 level. Okay, so traders, you need to take note of all this important information. Yep. Okay. Then, of course, some people asked me yesterday, Cal, I didn't see the special code. It was there, my friend, at about the, I think the 5th minute or so, right? The special code was there. It was a 5-second show and gone thingy, all right? I'm trying to do something different. Now, I know the last time I left it there for quite a while, but I just feel that if, let's say, you guys are only coming in to just get the lunch, I'm fine with that, but if you can make it a bit more interesting, a bit more challenging, that'd be cool. So apparently, I left the word FTX, okay, at the top right corner for about 5 seconds. It was there, and of course, well, some people caught it, right? These are the people who caught it. So which means that if you didn't see it, then just try. All right, now today is Tuesday, we don't have it, so it's every Monday, Wednesday, and Friday. Okay, all right, so just to clarify some matters, because I was asked this question. All right, let's look at the chart for today and see what do we have for you guys. Okay, so this is the S&P chart. As now I done and showed to you. Let's look at something more important, which is the dollar. Now the US dollar yesterday rebounded very nicely. All right, it's expected. I told you guys that the RSI, the last time we saw this was quite some time ago, so a rebound was expected. But can it continue? Now the US dollar has to cross back 108 to find any foot on its strength. So for people who are adventurous and they believe that the fundamental US dollar is going to be there, buying right now with a stop loss at the low makes a lot of sense because the risk reward ratio is pretty decent. Imagine if you risk just only here, okay, but the upside could be all the way here, then of course this risk reward ratio is worth it. Okay. Now, for VIX, right, we can see that recently it has shot up to the moving average, then it was hit and resisted over here. It pulls back down, it's back to 22. Yesterday, interestingly, it was down to about 23 again before closing at 23.75. So I believe that there is a pretty strong base at the moment right now. You can see that if I put a base here itself, you can see there's a strong base at the moment. So I still think that we can buy some VIX to do some hedging, especially we know that the put option now is actually gearing up. All right, last but not least is that we can take a look at the 10-year yield. Now the 10-year yield is basically side walking, but I believe that very soon if it crosses the 3.9%, it'll go back up to the 4.2%. And I still believe that the Federal Reserve will keep on hiking interest rate because of some data. And tonight's PPI data will be one of the key highlight. All right, now let's look at the US market for today, and this is Hong Kong first to start out with. Hong Kong market has started to go higher today. It's trading at 18,160. Now probably because that now the thing has they have met, the two leaders have met, so it's a bit better right now. So as long as the relationship stays good, that is good, right? Now China A50, we can see that yesterday it went all the way up first and it pulls back, but very interestingly it stopped exactly above my 12,280 marker. So now this morning it tested and pulls up, right? So it shows that the market is pretty strong around this area. So as long as the market stays above 12,280, the China A50 is kind of safe. All right, let's bring back more stuff for you. Okay, let's go. So let's look at the Dow Jones for now. Okay, so for the Dow Jones for today, you can take a look right now. The Dow Jones has two doji. Now it's DJDD stands for doji. And it's the second doji in a row. So usually when you see two doji side by side, that means big movement is going to happen. So the upside potential is 34,109. So if the market stays above it, we can see 34,109. But on a flip note, if the market basically stays below OP and goes down below 33,657, then 33,288 is most likely will happen. All right. So DJDD is either going to go up all the way or go down all the way. It's pretty early to call, so watch the market, especially after 2 p.m. Singapore time. KSI and KRW both are positive right now, so the downside limitation is kind of there. Now the Nasdaq, you can see it's also a doji formation, hence then as long as it stays above OP, it's a buy. At the moment now it's doing that, so it's above MLP, above OP. So the first target will be the KCB around here, which is about 11,875 level, and the BNB extension is 11,906. Now this is a third trading day to fourth trading day now. There's a high chance that the Nasdaq result we can see 11,906. Okay. All right, S&P 500. Let's take a quick look right now. S&P 500 seemingly got itself tripping the extension, and now 39.95 is a strong resistance. Now MLP for today is 39.74. As long as stay above that, the market should be able to retest 39.95 again. All right. For the Nikkei. Now Nikkei is also doing a doji, so which means that almost everybody's doing the same thing. That means something big is all happening, or everyone is waiting for the PPI data tonight. So if the Nikkei stays down and break below the 27,898 mark, that means that the market can come back down to 27,942. 27,492. Now do take note, all my indicators, all the numbers are all fully automated, so you don't need to do anything. You can actually apply it instantly. All right. Okay, so let's just look at the commodities right now. Okay, let's bring commodities in. So first of all, this is the gold chart right now. Gold has been pretty strong and resilient. Now it's because the US dollar is still side walking, hence therefore the people are still buying gold. But I just felt that there's a little bit of compression right now at about 1770 level. So just watch out for today. 1760 will be the very important pivot to hang on. If the gold stays above OP, all right, that means that gold can go even higher to 1779. But if it stays down and break below 1769, then 1760 could be next. Okay, so traders, you need to watch out for that. Okay. All right, then of course for silver, oh my God, silver yesterday has broke above the $22 mark. Okay, must give me a moment. A bit of technical issue right now. Hold on, yeah. Okay, silver has broke above the $22 mark very nicely, and likely is heading towards the $22.70. Now, I'm very, very bullish on silver, and I believe that the next pullback will be the best time to buy into some silver, and for the next rally, I still believe that silver will see about $28 to $30 by probably early January 2023. Okay, so watch out for that. Now for Bitcoin, well, unfortunately yesterday we were looking to short with Bitcoin. It did went down to 15,800. Then it rebounded strongly to 17,000, tripped our stop loss. Oh gosh. Okay, now for today, it's a DJDD right now, and by right, if it stays above OP, we should see it going back up again, and that will be 16,845 range. If not even higher, it's 18,562. But I say again, I believe that the US dollar will likely be strengthening in the near term. Hence, therefore, that will push down the Bitcoin down all the way to 14,425. So watch the US dollar. If the US dollar retain weakness, okay, that means that the Bitcoin, then other commodity will move higher. But if let's say the US dollar strengthen, then of course Bitcoin, this particular counter, I suspect there will be more selling, okay. And of course, you can see this is Ethereum, the new BNB right now. The upside is 1409, the downside is 1051. So same thing again. As long as the market stays above OP today and it's a DJDD, it should be able to test 1400. But same thing, if the market back because of the US dollar, which I believe will actually be strengthening ahead of PPI or during PPI, then we can see the price coming back down to the 1060 mark. All right. So take note of today's all these different important data and make sure you trade the market carefully. So this is Cal signing off. Wish you all the best. Bye bye.